Upbeat, cinematic music starts. Before you hit that buy button, before you chase the latest stock meme, there is one book you need to know. It is the book that separates the investors from the speculators. Imagine holding the exact blueprint that turned a modest sum into one of the largest fortunes in history. A blueprint written not in secret but in plain sight, yet understood by only a disciplined few. We are talking about the foundation of all rational investing. The book that directly shaped Warren Buffett's entire philosophy and helped create billions in wealth. What is it? The book is Benjamin Graham's masterpiece, Security Analysis. Published in 1934, in the shadow of the Great Depression, this is not just a book, it is a survival manual for your money. For decades, investors who read and applied this framework have consistently outperformed the market. If you are serious about wealth building and retiring comfortably, this book is essential. Security Analysis is the birth certificate of value investing. It shifted the perspective on stocks from mere slips of paper you trade to fractional ownership stakes in a real business. It gave investors a framework to think logically, even when the markets were chaotic. Graham is truly the investor's Bible. And the most famous follower? Warren Buffett. Buffett credits Graham with providing the intellectual framework for his entire investment life. If it worked for the Oracle of Omaha, we should certainly pay attention. Now, let's break down the core non-negotiable principles that underpin the entire book, starting with the two most crucial concepts. First, intrinsic value. This is the estimated actual worth of a company, determined by analyzing its assets, earnings potential, and dividends. It's what the business is really worth, independent of temporary market price movements. For an average investor, think of it like appraising a house. You look at comparable sales, rental income, and repair costs, not just the neighbor's inflated asking price. Next, the margin of safety, Graham's single greatest idea. It means only buying a security when its market price is substantially below your calculated intrinsic value. If a stock is truly worth $100, you aim to buy it for $60. That $40 buffer is your protective shield, safeguarding you against errors in judgment or unexpected downturns. Beyond intrinsic value, Graham demands a disciplined mindset and a deep commitment to analysis. Graham draws a clear line between investing and speculation. Investing is based on thorough analysis, protecting principal, and satisfactory returns. Speculation is buying something hoping its price goes up soon, essentially gambling. Are you buying a share of a business, or are you buying a lottery ticket? This requires fundamental analysis, rolling up your sleeves, and reading the balance sheet and income statements. It's not glamorous, but it's where reality lives. You're looking for evidence of profitability, manageable debt, and strong assets. This is the homework that most people skip. And then there's Mr. Market. Imagine you have a business partner, Mr. Market, who shows up every day offering to buy or sell your share. Sometimes he's ecstatic and overpays. Sometimes he's terrified and sells cheap. The genius of Graham is realizing Mr. Market exists to serve you, not guide you. Buy when he's depressed and sell when he's manic. How powerful are these concepts? Let's look at how they played out in real history, starting with Graham's most famous student. Buffett initially focused heavily on buying, quote, cigar butts, companies so cheap they were trading for less than their liquidation value, a classic Graham deep value play. While his strategy evolved to include, quote, great businesses at a fair price, the discipline of intrinsic value and margin of safety remained his guiding light. During the dot-com bubble, Graham investors watched others chase speculative growth. They stayed disciplined, protected their capital, and avoided the subsequent crash. The 2008 financial crisis was terrifying, but value investors who bought stable assets at absurdly low prices when Mr. Market was terrified made a fortune when prices eventually corrected to meet their intrinsic value. The wisdom of Graham is timeless. Let's capture a few of his most potent words of advice. Quote 1. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Graham teaches us that analysis is mandatory, and the preservation of capital must always come first. The main lesson for you today is simple. Think like an owner, not a trader. You are not buying tickets, you are buying businesses. Focus on long-term fundamentals, protect yourself with a margin of safety, and let emotional traders make the mistakes you capitalize on. Of course, a book written in 1934 will have outdated elements. Graham's ultra-conservative criteria, often focusing heavily on tangible net assets, works less well for modern growth companies like tech firms that have massive intangible assets. Many of his numerical formulas must be adjusted for today's market structure, but the underlying principles, Intrinsic value and margin of safety remain perfectly relevant. Motivational tone. Security analysis is more than a guide. It's a mindset transformation. It gives you the discipline to be patient, the patience to be analytical, and the courage to act when others are panicking. Embrace the discipline, think like an owner, and build true, lasting wealth. If you enjoyed this summary, subscribe to WiseReads Lab for more timeless books that build wealth and sharpen your mind.